Silver is trading near $72 today. On the surface, it looks like just another strong rally in a volatile metal. But beneath this price lies a story far bigger than charts, far bigger than speculation, and far more dangerous for anyone who thinks this move is accidental. Because silver does not move like this without a reason, and it never moves alone. For years, silver lived in gold's shadow. Gold made headlines, gold stole attention. Gold became the symbol of fear and safety. Silver was called the poor man's gold, a secondary metal, an industrial afterthought. But quietly, steadily, silver was being consumed by the modern world at a rate no one wanted to talk about. Today, that silence is breaking. At $72, silver is no longer whispering. It's warning. Just a few years ago, silver below $20 felt normal. Analysts argued endlessly about whether it was undervalued or dead money. Investors lost patience, traders got bored, governments barely mentioned it. But behind closed doors, something critical was changing: the way the global economy uses silver itself. Silver is no longer just a precious metal. It is a strategic material. Every solar panel that fuels the green energy revolution requires silver. Every electric vehicle, every advanced battery system, every semiconductor, every data center powering artificial intelligence consumes silver in microscopic quantities, quantities that add up to millions of ounces. Unlike gold, most of this silver is not recycled. Once it's used, it's gone, and yet supply hasn't kept up. Global silver mining has struggled for years. Ore grades are declining, costs are rising, new discoveries are rare, environmental regulations are tightening. Many silver mines aren't even pure silver mines. They're byproducts of copper, lead, or zinc operations. When those metals slow down, silver supply disappears with them. This is not theory. This is happening now. At the same time, governments around the world are pushing aggressive industrial agendas. Solar expansion targets, electric vehicle mandates, AI infrastructure spending, defense technology upgrades, all of it depends on silver, and none of it is slowing down. So when silver moved past $50, many thought it was excessive. When it crossed 60, people called it irrational. At 70, they started whispering the word bubble. But bubbles don't look like this. Bubbles are fueled by hype. Silver's rally is fueled by necessity. Behind the scenes, inventories have been draining. Physical silver stockpiles, the kind that actually exist, not paper contracts, have been quietly shrinking. Large industrial buyers are locking in long-term supply agreements. Mints and refiners are reporting tighter availability. Delivery times are stretching. Premiums are rising even when prices pull back. This is not panic buying. This is strategic buying. At the same time, geopolitics has entered the silver market in a way few expected. Trade tensions, sanctions, and export controls have reshaped global commodity flows. Countries are rethinking what materials they allow to leave their borders. Strategic metals are no longer treated like ordinary exports. They are leverage. Silver sits right in the middle of that shift. When a nation controls refining capacity, mining output, or industrial processing, it controls supply chains, and supply chains are power. That reality is now being felt across precious metals markets. Add to this a weakening confidence in fiat currencies. Inflation may rise and fall on headlines, but long-term trust has been damaged. Debt levels are historically extreme. Central banks talk tough, but markets sense the limits. Rate cuts are discussed before inflation is fully defeated. Investors know what that means. Hard assets matter again. Gold has already proven this. Silver is catching up, violently. But silver doesn't move like gold. When it moves, it overshoots. Historically, silver has always lagged gold at the start of precious metal bull markets. Then, suddenly, it accelerates. It spikes. It shocks. It leaves latecomers chasing price instead of understanding it. That pattern is forming again. At $72, silver is not expensive by historical ratios. In fact, compared to gold, it remains unusually cheap. The gold-to-silver ratio, a key metric watched by institutional investors, suggests silver still has room to run if historical relationships reassert themselves. And that's where the $100 question enters. $100 per ounce sounds extreme. It sounds sensational. It sounds like clickbait. But strip away emotion, and the math becomes uncomfortable. To reach $100 by 2026, silver does not need a miracle. It needs only three things to continue: sustained industrial demand, constrained supply, and persistent monetary uncertainty. All three are already present. What's missing is public awareness. Most people still think of silver as jewelry, coins, or speculation. They don't see it embedded in the systems that power modern civilization. They don't see how fragile supply really is. They don't see how quickly sentiment can flip when availability tightens. And when that realization hits, it doesn't arrive slowly. It arrives as a scramble. The silver market is small compared to global capital flows. It does not take trillions of dollars to move it. It takes a shift in perception. A realization that silver is not optional. It's essential. At that moment, prices don't climb politely. They gap, they spike, they shock. Today's $72 may one day be remembered not as the peak, but as the warning shot. The last moment when silver still looked reasonable before the world fully understood what it had ignored. Because silver does not wait for permission, and the forces driving it now are far larger than any single market, any single country, or any single prediction. This is not just about price. It's about control, scarcity, and the cost of modern progress. And in the next part of this story, we need to ask the question most people are avoiding. Who is buying silver right now, and why they are not talking about it? What makes this silver rally truly unsettling isn't just the price on the screen. It's the behavior behind it. Markets always leave footprints. And if you look closely at silver right now, the footprints don't belong to retail traders chasing momentum. They belong to players who don't make noise, don't give interviews, and don't explain themselves until long after the move is over. Because while the public debates whether $72 is too high, large buyers are not asking that question at all. They are asking something very different. How much silver can we secure before it becomes unavailable? This is where the story turns uncomfortable. In recent months, industrial consumers have been locking in silver supply at prices that would have sounded absurd just a few years ago. Solar manufacturers, electronics producers, defense contractors, and technology firms are not buying silver because they think it's cheap. They are buying because their production lines cannot function without it. For them, silver at $100 is not a disaster. Not having silver at any price is. And that fear is quietly spreading. Refineries are reporting tighter flows. Wholesalers are noticing that deliveries are becoming more selective. Some buyers are being told to wait. Others are being offered metal only with longer contracts or higher premiums. These are not rumors. This is how physical shortages begin, slowly, unevenly, and quietly. Paper markets still show liquidity. Futures still trade. Charts still move up and down. But physical markets operate on a different timeline. When supply tightens there, prices don't just rise, they disconnect from expectations. This disconnect is already forming. At the same time, something else is happening that most investors overlook. Central banks, traditionally obsessed with gold, are watching silver with renewed interest, not necessarily as a reserve asset, but as a strategic input. In a world where technology determines power, metals that enable technology become leverage. Silver is one of those metals. Countries that control refining, processing, or export permissions hold influence far beyond what price charts reveal. Export licensing rules, trade inspections, environmental controls, these are not random regulations. They are tools, and once deployed, they don't get rolled back easily. Every time a shipment is delayed, rerouted, or restricted, downstream industries feel it. And when industries feel it, they hedge. When they hedge, they buy forward. When they buy forward, they reduce available supply for everyone else. This is how a squeeze forms without headlines. Meanwhile, investors are starting to notice something else. Silver is no longer behaving like a secondary asset. Its volatility is increasing, yes, but so is its independence. It's not simply following gold. It's responding to its own fundamentals. That matters. Because when silver decouples from gold, it tends to move faster. Sharper rallies, deeper pullbacks, explosive upside when pressure builds. This is exactly how previous historic silver moves began. Quietly, skeptically, and then suddenly. But what truly sets this cycle apart is timing. The world is entering a phase of simultaneous pressures. High debt, geopolitical fragmentation, technological acceleration, and energy transition are all happening at once. In the past, these forces arrived in sequence. Now they overlap. Silver sits at the intersection of all of them. Energy transition needs silver. Technology expansion needs silver. Defense modernization needs silver. Currency distrust favors silver. Very few assets benefit from all four. And here's the part most people miss. Silver cannot be easily substituted. Engineers can reduce usage per unit, but they cannot eliminate it. There is no cheap replacement with the same conductivity, reliability, and performance. When silver prices rise, industries complain, but they still buy. That's the definition of inelastic demand. At the same time, investment demand is returning, but cautiously. This is not 2011-style mania. It's measured, strategic, often invisible. Long-term holders are accumulating quietly, not bragging on social media. That's dangerous for price stability. Because when silver finally captures mainstream attention again, when headlines shift from, "Is this a bubble?" to, "Why didn't we see this coming?" and "What supply will already be spoken for," that's when price discovery becomes violent. A move from $72 to $100 doesn't require hysteria. It requires recognition. And recognition spreads faster than supply can respond. Mining cannot ramp up overnight. Permits take years. Infrastructure takes capital. Skilled labor takes time. Even if prices scream higher tomorrow, new silver does not magically appear. This is the trap the market is walking into. Some analysts argue silver will correct sharply, and they may be right. in the short term. Volatility is part of silver's nature. Pullbacks shake out weak hands. They reset momentum. They create disbelief. But disbelief is fuel. Because the bigger question is not whether silver will pull back. It is whether the forces driving it will reverse. And so far, there is no sign of that. Instead, the signals point in the opposite direction. More industrial demand, more geopolitical friction, more monetary uncertainty, less easily available metal. This combination doesn't usually resolve quietly. It resolves with a repricing. And that repricing rarely happens in a straight line. It happens in bursts, sudden moves that leave charts full of gaps and commentators scrambling for explanations. The audience watching silver today is still small, but it's growing. And as it grows, the narrative will change. At first, people will say 72 was cheap, then they'll say 80 was obvious, then they'll say 90 happened too fast. And when 100 arrives, if it arrives, most will claim it was predictable all along. But the truth will be simpler. The market told the story early. Most people just didn't listen. And in the next part, we need to confront the most uncomfortable question of all. What happens if silver doesn't just reach $100, but overshoots it? There's a dangerous assumption built into most market forecasts. The assumption that prices move rationally, smoothly, and within comfortable boundaries. Silver has never respected that assumption. When silver moves, it doesn't stop where people expect. It overshoots. It stretches sentiment to the breaking point. It forces reactions instead of allowing preparation. And that is why the idea of $100 may be far less extreme than it sounds. Not because it is guaranteed, but because silver's history shows it rarely pauses at psychologically neat numbers. Look back at every major silver rally, and a pattern emerges. Long periods of neglect, followed by disbelief, then a sudden acceleration, and finally, chaos. The current phase feels eerily familiar. Right now, the dominant emotion in the market is still skepticism. Commentators argue about valuation. Traders wait for pullbacks. Analysts publish cautious notes warning of overheating. That skepticism is not a warning sign. It is a prerequisite. Silver does not peak when people doubt it. It peaks when people trust it. And we are nowhere near that point. Another factor quietly pushing silver toward instability is leverage. The silver market is heavily financialized. Paper contracts, derivatives, and synthetic exposure dwarf the amount of physical metal that actually exists. Under normal conditions, this structure functions smoothly. Under stress, it becomes fragile. If too many participants demand delivery at the same time, the system is forced to reveal its limits. This is not speculation. It has happened before. When confidence in paper promises weakens, physical metal becomes king. Premiums explode. Spot prices lose meaning. Two parallel markets emerge, one for contracts, one for reality. If that scenario unfolds again, prices will not rise politely, they will jump. And here's where the $100 conversation becomes inadequate. Because in a true supply stress event, silver doesn't ask for permission from forecasts. It doesn't check analyst models. It moves until demand is destroyed or supply appears. The question becomes, what price destroys demand? For investors, demand is elastic. At high prices, they sell. For industry, demand is not. Solar panels do not stop being built because silver is expensive. Data centers do not shut down because costs rise. Defense systems do not pause production because a metal spikes. Instead, costs get passed on. That means silver can rise far higher than most expect before demand truly weakens. This is why some market veterans whisper about numbers far above 100, not as predictions, but as possibilities if pressure builds faster than supply can respond. And pressure is building. Energy transition targets are not slowing. Governments are doubling down, not retreating. Artificial intelligence infrastructure is expanding aggressively, with massive server farms requiring dense electrical systems. Military spending is rising globally. All of it pulls on the same limited resource, silver. At the same time, recycling is not the solution people hope it is. Recovering silver from electronics is expensive, inefficient, and slow. It helps at the margins, but it does not replace mining output, and mining output itself is constrained. This creates a structural imbalance, not a temporary one. Markets can ignore imbalances for a long time. Then, suddenly, they cannot. Another accelerant lies in psychology. Once silver convincingly breaks certain levels, it changes who's allowed to buy it. Large funds, institutions, and momentum strategies often require confirmation before entering. When silver proves strength, these players are forced to chase or miss out. That is how rallies feed on themselves. At $72, silver is knocking on doors. At $80, it kicks them in. At $100, it changes the conversation entirely. At that point, the narrative will flip from can it go higher to how high is too high. And that is where danger and opportunity can coexist. But there is also risk. Silver's volatility cuts both ways. Sudden drops can be brutal. Corrections can feel like crashes. Weak hands get shaken out repeatedly. Media coverage turns negative at the worst possible moments. Fear replaces reason. This is not a market for the impatient. And yet, the long-term forces do not care about short-term emotion. Every dip that fails to break the structure tightens the coil further. Every consolidation above previous highs resets expectations upward. Every delay in new supply increases future pressure. This is how markets prepare for disorder without announcing it. The most telling sign may be silence from official sources. When markets are calm, authorities speak confidently. When uncertainty rises, language becomes vague. When stress builds, silence takes over. Silver is entering that quiet zone. No one wants to openly admit that a small, overlooked metal has become systemically important. No one wants to explain why inventories are shrinking. No one wants to trigger panic, but markets don't wait for permission to react. They respond to reality. And the reality is this: silver is no longer just reacting to gold or inflation headlines or short-term speculation. It is responding to a world that demands more from it than it can easily provide. That imbalance does not resolve gently. Whether $100 happens in 2026, earlier or later, is almost secondary. What matters is direction, pressure, and fragility. And all three are pointing the same way. The biggest mistake investors make is assuming they will have time to adjust. Silver does not grant that luxury. It moves first, explanations come later. And in the next part, we must confront the hardest truth of all. What happens after silver crosses a level that forces governments, industries, and markets to react at the same time? At some point, a market stops being just a market. It becomes a problem that needs to be managed. That moment often arrives quietly, without alarms, without headlines, and without official acknowledgement. Silver is approaching that threshold. When prices move from being inconvenient to being disruptive, the response changes. Industries complain louder. Governments take interest. Regulators start asking questions that were never asked before. And history shows that when strategic materials become too expensive or too scarce, intervention is never far away. But intervention does not mean reversal. It means distortion. If silver pushes decisively beyond levels that industries can easily absorb, one of three things happens. Either supply is increased, demand is destroyed, or access is controlled. The first option is slow. The second is politically unacceptable. That leaves the third: control. We have seen this playbook before with energy, food, and rare earths. Export restrictions, stockpile releases, strategic reserves, quiet agreements between nations, and sudden regulatory changes are all tools that appear when materials become sensitive. Silver is not immune. In fact, silver is particularly vulnerable because of how deeply embedded it is in modern infrastructure. Interrupting its flow even slightly can ripple across entire supply chains. That gives it power, and power attracts attention. This is where the silver market becomes dangerous in a different way. When prices rise due to fundamentals, markets adapt. When prices rise and threaten political or industrial stability, they provoke responses that no chart can predict. Those responses don't always push prices down. Sometimes they make things worse. Imagine a scenario where export rules tighten under the guise of national interest. Suddenly, metal that was technically available becomes practically unreachable. Buyers scramble. Prices spike. Panic spreads. Paper markets struggle to reflect physical reality. Now imagine that happening in an already tight market. This is why silver has a history of violent moves that seem disconnected from logic. They are not disconnected. They are reacting to pressures that exist outside normal trading models. At the same time, investor psychology shifts. When silver crosses certain psychological thresholds, it stops being dismissed as speculative and starts being treated as insurance. That change is subtle but powerful. Insurance is not bought for return. It is bought for protection, and people don't sell protection easily. As more holders move into that mindset, available supply shrinks further. This is how feedback loops form. Higher prices lead to more hoarding. More hoarding leads to less liquidity. Less liquidity leads to sharper moves. Sharper moves attract more attention. The cycle feeds itself. By the time silver approaches or crosses $100, the debate will no longer be about valuation. It will be about exposure. Who has silver? Who doesn't? And who is suddenly vulnerable because of it? That vulnerability extends beyond investors. Manufacturers with thin margins will feel the pressure first. Governments will be forced to choose between subsidizing costs or allowing prices to rise. Consumers will pay indirectly, even if they never touch silver themselves. This is how a metal becomes a political issue. And once politics enter the market, predictability leaves. The most dangerous phase of any commodity rally is not the beginning. It's the moment when everyone realizes it matters, but too late to prepare calmly. Silver is creeping toward that moment. And yet, most people are still focused on short-term moves. They watch daily candles, they argue over pullbacks, they debate whether $72 is sustainable. They miss the larger picture entirely. This is not about today's price, it's about tomorrow's constraints. Every system has limits. The silver market is discovering its own. If prices retreat temporarily, the narrative will claim the danger has passed. If prices surge, the narrative will claim greed has taken over. Both interpretations miss the truth. The truth is structural, and structural problems don't disappear because markets want them to. They resolve through repricing. Whether that repricing stops at 100 or overshoots is unknowable. What is knowable is this: once silver forces itself into the global conversation, it will not quietly fade back into obscurity. It has already crossed the line from overlooked to unavoidable. The only remaining question is how violently the world acknowledges that fact. And in the final part, we must bring this story to its sharpest edge: what this means for the viewer watching right now, and why silver's next move may arrive faster than anyone expects. There is a moment in every major market shift when the window quietly closes, not with a crash, not with a headline, but with a realization that what once felt optional is no longer available on your terms. Silver is approaching that moment. For the viewer watching this right now, the most dangerous assumption is believing there will be time. Time to wait for confirmation. Time to wait for pullbacks. Time to wait until the story is obvious. Markets rarely offer that luxury. Silver, yes, greatest moves have always happened when most people were still debating whether anything was happening at all. By the time consensus forms, the opportunity has already transformed into risk management. That doesn't mean silver will move straight up. It never does. It means the balance of probabilities is shifting in a way that favors surprise over comfort. At $72, silver feels expensive compared to its past. But the past is no longer the correct reference point. The world that once produced silver abundance no longer exists. The world that once treated silver as a secondary metal is gone. Today's world consumes silver relentlessly, strategically, and with little regard for long-term supply. That mismatch cannot be resolved by opinion. It can only be resolved by price. $100 is not a magical number. It is a signal that the market has acknowledged reality, that supply, demand, and trust have found a new balance, temporarily, and even that balance may not hold. What matters more than any price target is understanding why this is happening now. Not 5 years ago, not 10, now. The answer lies in convergence. Debt has converged with technology. Energy transition has converged with geopolitics. Monetary policy has converged with material scarcity. Silver sits at the center of that convergence. This is why attempts to dismiss the move feel increasingly hollow. This is why corrections fail to break structure. This is why every dip attracts buyers who are not interested in flipping, only in securing. And this is why the next phase may not announce itself politely. If silver moves toward 100, it will not do so because everyone agrees. It will do so because enough participants decide they cannot afford to be without it. That decision does not require optimism. It requires fear of absence, fear of not having supply, fear of being unhedged, fear of being last. That fear is powerful. And once it spreads, silver's behavior changes completely. Volatility increases, liquidity thins, price gaps appear, narratives shift overnight. What once felt theoretical becomes personal. This is the phase where people stop asking, should I buy? And start asking, how exposed am I? By then, silver no longer belongs to speculators. It belongs to necessity. The uncomfortable truth is that most people will experience this move emotionally, not strategically. They will feel excitement, then anxiety, then regret, in that order. Very few will remain calm enough to act rationally. That is not a judgment, it is a pattern. Silver has always been the metal that punishes complacency and rewards preparation. It does not offer smooth rides. It does not respect comfort. It does not care about consensus. It simply responds to pressure. And pressure is everywhere now. Whether silver reaches 100 in 2026 or overshoots it in a moment of panic is less important than recognizing what 72 already tells us. The system is under strain. The market is signaling something long before headlines catch up. The question is not whether silver will remain volatile. It will. The question is whether you understand why. Because understanding changes how you react, and reaction is everything when markets move faster than narratives. Silver does not move on belief. It moves on need. And the world needs silver more than it ever has. What happens next will not be decided by forecasts, opinions, or arguments in comment sections. It will be decided by physical reality, by what exists, what is required, and what cannot be replaced. That is why this story matters. Not because of $100, but because of what 72 already implies. Silver is no longer asking to be noticed. It is demanding it. And by the time everyone agrees, it will already be somewhere else.